Hi everybody, and welcome to this lecture on the cost of capital. Let's just take a moment and go through a quick overview of what we're going to talk about. I want to just set the stage on what I mean by the cost of capital and why we want to discuss this. And then we will go into calculating the different component costs, which are debt, preferred stock, and common stock equity. Finally, we'll put it all together and look at the WACC, which is the weighted average cost of capital. And we'll talk about some factors that affect the WACC, and then we will wrap up the lecture. So let's just set the stage here for this lecture. Companies fund their long-term activities through any of the following financing sources: through long-term debt, preferred stock, and common stock equity. And company managers and investors, and by investors I mean the providers of either debt or equity. So company managers and investors need a way to calculate the overall costs of a company's capital. And they use this cost in a number of different ways. Two of the most important ones are as a benchmark for new investment opportunities, and as a way to help them value the company as a whole. So this is a critical piece of our value equation, the cost of capital. So we're going to spend a little bit of time understanding how we calculate it. So now we can calculate a company level cost of capital. The company level cost of capital by calculating each of the component capital costs and then calculating a weighted average of these costs relative to how much of each type the company is using. So while the costs of capital vary across companies, those in similar industries or with similar risk characteristics tend to have similar capital costs. So these are things that are unique for each company, and you have to calculate them each individually. But generally, companies that are in the same industries with similar characteristics will have pretty close to the same capital costs in general. So now, we focus on the sources of capital that are funded from the investors of debt and equity. And the focus is on the capital that comes from the investors. There's other capital that the company deploys, such as the working capital, that is not funded by the investors. It's funded by the vendors of the company, for example, or by the government for deferred taxes and things like that. So for accounts payable, for certain accruals, for deferred taxes, while these are sources of financing, they are not funded from the investors. So we don't include them in our cost of capital equation. But note that we do adjust for these items when we calculate the cash flows of a project, just not when we're calculating the cost of capital. So another issue is the taxes. Do we want to look at before or after tax capital costs? So now the tax effects associated with financing can be incorporated either in capital budgeting, in the cash flows, or in the cost of capital. And just to take a moment, we're talking about, if you can picture that value equation where we've got cash flows on the top and a discount rate on the bottom. The cash flows that we're talking about here is that numerator, and our cost of capital is the denominator. It's the discount rate. So the tax effects could be factored in to either the numerator or the denominator. But most firms, and by convention, we incorporate the tax effects into the cost of capital portion of that equation. So because of that, we will be using the after-tax costs where this is relevant. And it is it's generally only relevant for debt. So when we calculate debt, we want to look at the after-tax cost of debt. Another issue is historical versus future costs, or marginal costs. So now, the cost of capital is used primarily to make decisions which involve raising capital or investing new capital. These are future-focusing activities. So because of that, we focus more on the marginal or the future costs of capital. So the future costs may be different from historical, although generally we'll look to the historical to give us some guidance. But if the company decides that it's going to be making some important changes that are different from recent history, then we would want to try and make estimates that are consistent with those new future expected changes. Alright, so now let's focus on the first of the capital cost components, the cost of debt. There are three methods that we can use to calculate the cost of debt. So method one, well, this is we can ask an investment banker what the coupon rate would be on new debt. You can just phone most companies, larger company at least, have relationships with investment bankers, and they can just get on the phone and explain what they're trying to do, and the banker can give them an answer. So, that's fine. Although the banker's doing some number crunching somewhere behind the scenes, so, we kind of want to know, well, what are they doing? But, this is valid. Another method is it's a bond rating method. So we find the bond rating for the company or for a similar company, and if our company doesn't have a bond, and we use the yield on the bonds with similar ratings. And that's a good way to do it. And then finally, the third method, which we'll give an example of next, is we can find the yield on the company's debt. Assuming the company actually has debt in the market, we can look at the debt and see what the market is pricing the debt at. So you can do any or all three of these, and you can do all three and take an average. We're going to do just method 3 just to see how we do this. And it shouldn't be a surprise, we've actually looked at this earlier in the course. So let's take a look at that. This is an example of method 3, calculating the yield to maturity of a bond. So let's assume we have a bond with the following characteristics. It's a 15-year maturity, 12% semi-annual coupon payments, and the bond is currently selling for $1,153. What is R of D? What is the cost of debt? Well, we can put a timeline together, and in this case, we have the inputs to a financial calculator. You could do it in Excel, and we really just crunch the numbers here. So on our timeline, just to review this, we have at time 0, this is the current price, which is $1,153.72, and we enter that as a negative, and we've seen that previously. And then we have, it's a 15-year semi-annual, so we actually have 30 periods. It's a 12% payment, so $120 divided by 2 for 2 periods. We have $60, 30 periods of $60 payments. And at the end, we have the face value paid back, and that's just $1,000. So we can plug these numbers into our into our yield to maturity equation, and we get, so we have 30 for N. We're trying to find this I over YR. We know the present value, we know the payment, and we know the future value. So we get an output of 5%, and this is for semi-annual. We multiply it by 2 for the year, and we find that the cost of debt is 10%. Now, interest, we talked about interest a little bit ago, and we want to look at the after-tax we want to look at the after-tax value. And interest is tax deductible. So the after-tax costs associated with the interest for debt can be calculated as follows. It's the cost of the debt, RD, times the after tax, which equals the cost of debt before tax times 1 minus the marginal tax rate. So it's the which just reduces to 6%. It's 10% times 1 minus the tax rate, and I'm just assuming that it's 40% here. So that's 60% in the parentheses times 10%, and we're left with 6%. So the after-tax R of AD, RD of AT, the after-tax cost of debt is 6%. It was 10% before tax, 6% after. Note, if there are flotation costs associated with this. This is why our friendly investment banker was happy to take our phone call and tell us how much it cost, because if we were actually issuing these bonds, they would be the ones to facilitate that, and they would charge a small fee. But in general, the flotation costs on bonds, typically relative to the offerings, they're not so big. So for our purposes, we can just ignore them. And so in this example, the component cost of debt after tax is 6%. All right, so let's talk about the cost of preferred stock. Let's say we have the following preferred stock. The price of the preferred stock today is $116.95. It pays 10% per quarter on a par value of $100. And it has a flotation cost, which we designate as F, which is 5% of the total price today. So what can we do to calculate this? All right, well, let me give you a formula here. So what we can do is we can say that the cost of the preferred stock is equal to the dividend divided by the price times, we have to back out the flotation costs. So it's the amount of money that we receive after paying for the flotation costs is the denominator. And on the numerator, it's the dividend that's being paid out. So let me just fill in the numbers and we can talk about that for a moment. We know that it pays 10% and it's based on a $100 face value. Now this is a per quarter basis, but it's 10% times 100. So that's where, even though it's on a quarterly basis, the annualized amount is $100. So we will be receiving $10 during the year. And the basis of this, the company receives $116.95 minus 5% of that, which it pays to the investment bank that issues these, that helps them issue these, which is just $10 divided by the denominator becomes 111, or 9%. That reduces to, it's a 9% yield on these preferred stocks. So the component cost of capital for this is 9%. There's another way to calculate this, and we can use a timeline for that. And this may be a little more intuitive. We set up a perpetuity where our initial price is the after flotation costs price. This is the amount of money that the company actually receives. It's $111, and that's a negative. We set it up just like a regular valuation of a timeline when the present value is, we enter it as a negative. And then every quarter we receive $2.50 is paid out. And that goes on forever because it has no end. It's a perpetuity. So this is calculated as a perpetuity, which is simply then the dividend per quarter divided by the discount rate for the period. And we set that equal to the price today. If we fill in what we know that the dividend per quarter is $2.50. We don't know, we're solving for the discount rate. Well, we can just rearrange this, and we get 250 divided by 111, 250 divided by the price, and that's 2.25%. Okay, well, we're almost done. We know that this is on a quarterly basis, so to convert it to an annualized basis, we multiply it by 4, which is 9%. And we get the same value. So that's good. That's a good check. The conclusion is the cost of the preferred stock is 9%. So now, a couple of takeaways. The flotation costs for preferred stocks they're significant. Unlike for bonds, where we're able to ignore them, the underwriter that facilitates this, they take a pretty big cut. Right? In this example, it was 5%. In common stock equity, it's even more. But these guys took a pretty big cut, so we wanted to include that in our equation. Preferred dividends are also not deductible for tax purposes, so there's no tax adjustment. We just use the value that we calculated, 9%. Alright, so now let's move on to our third capital component, which is common stock equity. Now there are two ways that companies can we can think of raising common stock. One is we issue new common stock, just like we issued bonds or issued preferred stock. We can think of that as the direct way. More indirectly and more commonly, companies have retained earnings. They earn a profit. They keep some of that profit internally. Some of it maybe they distribute in the form of dividends, and then some of it they'll keep. And they reinvest those earnings. So the earnings that are reinvested and not paid out, it's as though it's getting that money from the market. So there's an implicit cost associated with the retained earnings. It's really an opportunity cost. So in either case, there's an implied cost of the equity that the shareholders are requiring. So we turn to calculating this cost of equity next. There are three methods to calculate the cost of common stock: the capital asset pricing model, discounted cash flows, and something called Own-Bond-Yield-Plus-Judgmental risk premium. It's kind of a mouthful. When we get to it, it's actually pretty straightforward. So some of these terms should look familiar, and we'll go through each of these. So let's start with the CAPM. Well, from the CAPM lecture, we know that the cost of a stock is equal to the risk-free rate plus the risk premium on the market times the beta for that stock. We can just plug in the values. We can do some research and find all these numbers for a given stock. So let's just say we have the risk-free rate, we're told it's 5.6%, the market risk premium is 6%, and beta is 1.2 for a given stock. Then we can calculate the cost of equity at it's 5.6, the risk-free rate, plus 6% times 1.2 is 12.8%, if I've done my math correctly. So from the CAPM method, the cost of equity is 12.8%. And this follows from the lecture on the CAPM. So now a couple of issues on the CAPM. So most analysts use the rate on long-term government bonds to estimate the risk-free rates, typically 10 years, sometimes 20. And most analysts, now we saw previously that the risk premium, it changes over time. And depending on where we are, the range, it's been roughly 3.5% to 6%. So, but it does change, and these are the caveats that we had talked about previously with the CAPM. The inputs are not constant over time, so you just need to be aware of that. And we talked quite a bit about beta, and beta changes, and depending on who's calculating beta, it will be one number versus a number. So it can potentially range, have a fairly large range. All right, so let's turn to the DCF, the discounted cash flow model. So from our earlier lectures, we know that the return of a stock can be calculated as the dividend yield plus the growth rate. How do we get that? Well, this is from a rearrangement of the dividend discount model, which we saw when we talked about how to value stocks. And from this model, the first term is the dividend yield. It's the dividend payment divided by the price of the stock plus the growth rate of the dividend. All right, so let's see an example of how to actually use the DCF. Let's plug in some numbers. All right, let's assume the following. We have a dividend today of $3.12. We have a price today of $50. This is the stock price today. And we have a growth rate of the dividends at 5.8%. So if we bring in the equation from the previous slide and then fill in the values, we have the dividend next year is going to be our dividend today times the growth rate, which is 1.058. So it's 312 times 1.058 divided by 50, and that's our dividend yield. And then we add the growth rate of the dividend, which is 5.8%. And we have 6.6 plus 5.8, which is 12.4%. So for the DCF, our cost of equity is 12.4%. One issue with using the DCF is we need to be able to estimate the growth rate. That's a key factor in this. The dividends we can look up historically, and it may or may not be accurate, but we can look it up. The growth rate is really the key driver. So now we can use the historical growth rate if we believe the future will be like the past. Right? We can actually calculate that. We can obtain analyst estimates. Again, this is similar to beta. There are services that calculate this. And another method is we can use something called the earnings retention model, and we'll discuss that briefly. Now, suppose the company has been earning 15% on equity. So it's got a return on equity of 15%. And it's been paying out to the shareholders 62% of the earnings. Right? I'm just making up these numbers, but let's just say this is what's happening. So now, if this situation is expected to continue, what is the expected future growth rate? Growth can be thought of as, the growth rate can be thought of as the retention rate times the return on equity. I'll define that in a second. So the retention rate is the amount of the return on equity that we will be retaining within the company. It's the percentage that we retain. Typically, companies speak about their payout rates. and that is the percentage of their equity that they pay out, the percentage of the return on equity that they pay out to their shareholders in the form of dividends or stock buybacks, for example. So the retention rate is just the opposite of the payout rate. They add up to 100%. So if we know the payout rate, we take 1 minus that and we get the retention rate. And we know the payout rate. We're told that 62% of the ROE is paid out. So 1 minus that times our return on equity is equal to 5.7%. So in this case, we can calculate that the growth rate is 5.7. And we're making an assumption that the payout rate today is going to be consistent with what will be happening in the future. And that may or may not be true, but we have to make some assumptions. So this is close to the growth rate that we saw earlier. Finally, we had a third method, which is called the Own-Bond-Yield-Plus-Judgmental risk premium method. What is this? So let's just say the company has bonds in the market. What we can do then is apply a risk premium to the price of those bonds to estimate the cost of the common stock. And it actually doesn't even have to be the company's own bonds. We could, if our company didn't have bonds, we could look to the market and try and find a really similar company that has bonds in the market and look at the price of those bonds, find out what the yield is, and add some kind of a risk premium to that. So here's an example. Let's assume that the cost of the debt, the cost of our bonds, is 10%, which we calculated earlier. And we believe that a risk premium on the bonds is 3.2%. So in other words, shareholders of common stock need an extra 3.2% above what bondholders need in order to hold the stock. So that's just a judgment. We have to rely on our expertise or somebody else's expertise to come up with that number. And from that, we can calculate the stock, the price of the stock. So the required return of the stock is going to be the required return of the debt plus this risk premium, which is 10 plus 3.2, which equals 13.2. So this is by far the least formal of the three methods. But it's a good gut check or ballpark check. Make a sanity check. Just a quick note, the risk premium here, we've used that term before. This is not at all the same as the market risk premium. The market risk premium is specific to the CAPM. This is just some risk premium that the shareholders of this stock require above what bondholders require to hold the bonds. So it's really a best guess estimate. All right, so now we've done three methods here, right? We could really use any single method to calculate the cost of stock. You don't need all three. But if we've already calculated, if we've calculated them, we can use them. So we could take an average, for example. And here I present an average. So we have the CAPM, the DCF, and the bond plus judgment, and here's the different values. And you can just take an average. And you can see they're all, roughly they're all in the same range. So that's good. And a lot of finance is like this. There's multiple methods for a lot of different. They're calculating a lot of different things, and you'll want to use as much time and resources as you're able to spend to try and look at an analysis or evaluation from a few different angles. And then you kind of triangulate to get to the one that you feel most comfortable with. Because ultimately, if you move forward with something, you have to put a specific amount of money on the table. So you need to come to a conclusion, even with slightly differing values from the different methods. So now we can finally, once we have all these component costs, we can finally move on to the weighted average of the costs, the weighted average cost of capital. Right? That's what this method is known as. And the weights are the percentage total of that financing source compared to all financing sources. And again, we're looking at the financing that's provided by the lenders and the shareholders. So let's do that next. So estimating the weights. This is step 1. We need to estimate the weights. So we start by calculating the total value of all funding sources. So suppose, as funding sources from our investors, suppose the stock price is $50 and there are 3 million shares of stock. The firm has in addition, the firm has $25 million of preferred stock and it has $75 million of debt. So we can calculate the total value of funding the company is using as follows. The value of the stock is 50 times $50 times 3 million shares, or $150 million. The value of the preferred is, well, we're told is 25, and the value of the debt is 75. Right, so where do we get the 50? Well, we just looked at the stock market price and we saw it's trading at $50, and we know that there's 3 million shares in the market. Now, this is stuff we can look up pretty readily. Same thing with the preferred stock, we can look that up. And the debt, we can calculate the market price of the debt and multiply it by the amount of debt floating out there. So, we can get these numbers pretty accurately. Now you'll notice that the total value is the value of, just add them all up, the value of the stock plus the preferred plus the debt. And when you do that, you get $250 million. So the total value is $250. Step 2 is as follows for estimating the weights. Now we just calculate the percent for each component. And this is pretty straightforward. We calculate weights, which is just the value of the component cost divided by the total. So it's 150 is the component cost of the stock, and the total value is 250, which is what we calculated on the previous slide, which is 60%, 0.6 or 60%. For the preferred stock, it's 25 million divided by 250, or 10%, and for the bonds, the weight is 75, the value of the debt outstanding, divided by the whole, which is 250, or 30%. And you'll note that the weights add up to 100%, which is what we would expect and require, because these represent 100% of the investor sources. Alright, so let's put it all together. So we can put everything together and calculate the overall WACC for our company now. And the formula is as follows. The WACC is equal to the weight of the debt times the cost of the debt times 1 minus the marginal tax rate, plus the weight of the preferred stock times the cost of the preferred stock, plus the weight of the common stock times the cost of the common stock. It's actually pretty intuitive once you see all the previous stuff that we talked about. Now we can just plug in the numbers from what we've been calculating over the last several slides. The weight of the debt is 0.3 or 30% times a pre-tax value of 10%, and then we have to back out the tax component, 1 minus 0.4. The cost of the preferred, the weight of the preferred is 10%, and the cost is 9, and then 6 and 12, 0.8. So we could have easily just written this as, instead of 0.3, it could have been 30% times 10%. And this could have been, instead of 0.1, 10% times 9%. And 0.6 could have been 6%, 60%, and instead of 0.6. So they get you, it's the same math. But just be careful. If you use 60, make sure it's percent and not 60. Otherwise, you're going to get some big numbers. All right, and when you crunch the numbers, you get about 10.4%. It's a blending of the three different costs, and that is the weighted average cost of capital. So, all right, that's a lot of effort to calculate the cost of capital, and because not only are you crunching all these, you're calculating for potentially three different component costs, and maybe you're doing multiple methods for each of them to make sure each one is accurate, but then you're looking up data for all of this stuff. So there's just a lot. There's a lot of little steps involved. All right, so it's a little bit of effort, but it will be put to good use. Rest assured, the WACC is used throughout corporate finance. So in subsequent lectures, we will apply the WACC in a variety of uses within the field of corporate finance. And I already hinted at some of them for valuing, helping to evaluate whether or not to invest in new projects and doing overall company level valuations. Those are two important areas. And there are other areas where we use this. I want to just take a moment and talk about some of the factors that influence a company's WACC, because some of them the company has control over and some of them they don't. So it's good to know what the company managers can influence and nudge. So let me start with the uncontrollable factors. Market conditions, especially interest rates, the company has no control over these, and these are very influential on the value of the cost of capital. The market risk premium is beyond the control of the company, and tax rates. And all these things bear importantly on the cost of capital calculation. Some things that the company can control are the capital structure policy, the amount of debt and equity, essentially, that are used in sourcing long-term capital. And we'll talk about this. This is a big issue, capital structure policy. We're going to talk about it in detail in a few lectures. Very related to capital structure policy is dividend policy. Do we pay out some of our retained earnings? How much do we pay out? Do we keep it? Do we pay it in dividends? Do we buy back shares? What are we doing with money? What are we doing with our retained earnings? So that will impact the weighted average cost of capital. And then the investment policy, what are we doing with our money? How are we spending it? What projects are we investing in? So these are things that really those are the big buckets of corporate finance, and corporate finance managers need to be constantly thinking about these categories when they're doing everything in their companies. In summary, a company's cost of capital is a weighted average of all of its component capital costs. To calculate this, we calculate each component's cost separately. The debt, which is after tax, the preferred stock, and the common stock. And we have a few different methods for each of those. Then we weight these by the percentage amount of each is used in the total financing of the company. And that's the WACC formula, which is this. So I won't read it. I've already read it. You can see it here. And that is the cost of capital lecture.